Once upon a time on Wall Street, there was a man named Bernard Madoff. He was a respected broker and an honest businessman, or so everyone thought. Madoff ran his own investment firm and was known for being exceptionally trustworthy. But behind closed doors, he was running the largest Ponzi scheme in the history of mankind. So how did he get away with it? And why didn't anyone see it coming? If you were a rich person in the early 2000s, you might have been approached by your banker about investing in something special. It would be very exclusive, very low risk, and very profitable, but you'd have to act fast because this offer won't be around for long. This is what's called scarcity pricing, where an offer seems more appealing simply because it's rare. And this was just the start. Bernard Madoff had built his company from the ground up since the 1960s. It was called Bernard L. Madoff Investment Securities. To make his pitch more believable, he leveraged his respectable image. But the main draw for investors was the promise of a good return. Bernard claimed he could make them at least 10% every year, no matter what the market was doing. Usually, investing comes with a lot of risk. You might lose everything. That was not the case with Bernard. He promised that his investors would never, ever lose money. It was a bold claim, but one that many rich people were willing to go for. Bernard's firm seemed like the safest option out there. He used the same strategy to attract big banks like UBS, HSBC, JP Morgan, and more. They deposited their customers' money into Bernard's firm because they knew it was safe. After all, it was recommended by their bankers. But these were only the basic ingredients. To really sell the product, he needed a secret sauce, and that came in the form of exclusivity. The rich love the feeling of being part of a small group. They want to feel special. So when Bernard said that only a few select people could invest with him, it made his offer far more appealing. Of course, this wasn't actually true. Anyone with enough money could invest with Bernard. He just liked to pretend that there were limited spots available. This created a sense of urgency, making people rush into investments without thinking properly. Many of Bernard's clients were already millionaires or billionaires, but they still wanted to grow their wealth in a safe way. So when someone like Bernard came along, offering guaranteed returns, they were all ears. Bernard also attracted charities, universities, synagogues, pension funds, and more. There were three main reasons for this. First, he offered low risk. Second, he offered steady returns. And third, he was extremely well connected. This gave people the impression that if Bernard was able to attract these types of clients, then he must be legit. Plus, once people saw other people getting good returns, word of mouth started to spread. More and more people wanted in on this exclusive deal. But it wasn't all sunshine and rainbows. In 1991, a financial analyst by the name of Harry Markopoulos sent a letter to the SEC. It outlined how Bernard was running a massive Ponzi scheme and that he had lost millions trying to expose it. This was the first of many red flags. But unfortunately, no one listened. In fact, one of Bernard's biggest investors was none other than the SEC itself. This made it very unlikely that they'd take action against him. You see, in order for the SEC to investigate Bernard, they'd have to assume that he was guilty. But Bernard was well liked. Everyone loved him. He was a member of the exclusive Wall Streeters Club. He donated tons of money to charity. And he helped found the NASDAQ stock exchange. It was hard to believe that someone like Bernard could do something like this. This next part is what really makes the story interesting. Let's dive into exactly how the scam worked. Now, before we start, please subscribe to our channel. We put out videos like this one every single week and it takes less than 2 seconds. Now, it's important to note that Bernard never invested anyone's money. That goes against the entire purpose of an investment firm. They're supposed to take your money and put it into assets like stocks, bonds, or real estate. But Bernard didn't do any of that. Instead, he simply held cash and paid out profits using the money from new investors. This is the exact definition of a Ponzi scheme. Let me explain. Imagine 100 people each invest $1,000 into Bernard. He pays the first person $110. Then the second person invests $1,000, and Bernard pays them $110. He does this all the way down the line. The first person gets their $1,100 and invests it again. The second person gets their $1,100 and invests it again. This creates an illusion of profit and keeps people reinvesting their money over and over again. But eventually, you run out of other people's money. At this point, you need new investors just to keep the show running. That's why Bernard promised his investors that they would never lose money. If they were ever to ask for a withdrawal, he would pull it from money invested by newer clients. Unfortunately, this is the same tactic that many scammers use today. They promise low risk and steady returns, but in reality, they're just paying off old investors with money from new investors. Bernard was able to keep this going for decades, but like all Ponzi schemes, it eventually collapsed. The catalyst was the financial crisis of 2008. During the crash, many of Bernard's investors lost their jobs and wanted to withdraw their money. But Bernard didn't have any money to give them. There was never any money to begin with. All he had were the deposits from newer investors. But now that the economy was in shambles, he couldn't get any more money. Bernard tried to keep things afloat for as long as he could, but eventually he confessed to his sons that he'd gotten himself into too deep. When they realized the gravity of the situation, Bernard's sons alerted the FBI. He was arrested in December of 2008. This caused quite the uproar. Bernard was so respected on Wall Street that many people thought it was a mistake. They said that he was a good guy and a pillar of his community, but it soon became clear that there was no mistake. Bernard was sentenced to 150 years in prison. His companies were dissolved and his assets were liquidated to pay back his investors. It's estimated that Bernard scammed people out of a total of $65 billion. This is why his name will forever be remembered as synonymous with fraud. Even his family wasn't safe. One of his sons died by suicide and another was disbarred after stealing client funds. The fallout was felt all around the world. Thousands of victims were left out of pocket. Some lost their entire retirement fund. Others lost money that was intended for charity or for a nonprofit. One of the victims was a foundation created in memory of 9/11 firefighters. Bernard had stolen $2 million that was supposed to go to families of fallen heroes. In terms of the SEC, they were heavily criticized for not doing their job. They received numerous red flags about Bernard, but they chose to ignore them. Perhaps they were blinded by Bernard's reputation, or maybe they simply didn't know how to spot a Ponzi scheme. Either way, they failed to protect investors and were forced to admit negligence. Bernard Madoff will forever be known as the most prolific scammer of all time. In 2019, Netflix released a documentary about his life. They also published a book and multiple articles about the fraud. And in 2020, Congress passed the Madoff Investor Protection Act to prevent another scandal like this from happening. Although Bernard is over 80 years old, he's still serving his 150-year sentence. He's currently at the Federal Correctional Institution in North Carolina. Hopefully, he spends the rest of his days thinking about all the lives he ruined. Also, be sure to subscribe and check out some of our other videos.